introduce you to a mortgage broker, a qualified mortgage broker. I know I'm going to get the name wrong. Miriam Nawagamuwa. Is that
Close, close. Good effort, good effort. Yeah, no, always there. Nawagamuwa.
Okay, Nawagamuwa. I'll get it right one day. And you are a qualified mortgage broker dealing with residential, buy-to-lets, across the spectrum of regulated mortgages, I guess.
Yeah, that's right. So I'm from Larkin Financial Services. So we based in London, but operate across England, Scotland, and Wales.
Okay.
And I deal with mortgage advice, so buy-to-let and residential mortgages, and then also the associated insurances, so things like builders and contents insurance, life insurance, critical illness, and income protection.
Great, fantastic. Well, that's good. We'll put your contact details up at the end so people can get in touch with you. But just on the question of cover for buildings, I was talking to someone the other day, and the cost of building has gone up so much, and I'm not sure that everybody is insuring themselves sufficiently to cover the building costs. They might have just left it running for years, but if building costs have gone up by 20–30%, a lot of people might be underinsured.
Yeah, that can happen, especially if you have taken out a mortgage quite a while ago and just renewed every year without sort of reviewing the sum assured costs. So it might be worth checking to see what when it comes up for renewal, to speak to the advisor and find out what the new build cost is, just to make sure that you're definitely insured. You don't want to get to a point where you're making a claim on builders insurance and you find out you've not covered yourself for enough when you've been paying the insurance all this time as well. So that's something we look at. Yeah,
and that's true for any insurance. Don't be underinsured, because the insurance company will cut down your claim accordingly. So I know that in the mortgage market and property market in general, what I've been reporting is that every month, according to the Halifax and nationwide surveys, that property prices have been coming down for about the last 5 months. They're still up on year by about 9%. But how are you finding the market at the moment from your side, where you're used to dealing with lots of people and landlords and buyers? How are you finding things in general at the moment?
Yeah, so after sort of the fiasco towards the end of last year and the increase in interest rates, the market was very quiet in December, obviously because of Christmas and New Year's and all that. And then this year started off fairly quiet as well. People are a bit hesitant to buy because of the interest rates, not sure what's happening. But now coming to the end of the first quarter of the year, it does seem to be picking up again. Not so much in terms of new purchases, but more with the remortgage side of things. Okay. It's expected, I think, about 1.8 million remortgages are due for renewal this year alone. So
yeah,
even though the buying market might be quieting down a bit compared to the last 2 years, the remortgages still need to be done, and we're seeing more and more of those at the moment.
Okay, now I read in the Evening Standard recently that they called it a mortgage hammer blow for people coming off of fixed rates. And as you said, there's 1.8 million people coming off of fixed rates, hundreds of thousands every month. So how are you finding things? They must be in for a bit of a nasty shock when they're perhaps on a 2 or 3% fixed rate that's going up to 4 or 5.
Yeah, so people who have taken out mortgages in the last 2 to 5 years, they really enjoyed the very low interest rates we've had for the past sort of almost 10 years.
Definitely.
And those people might be on rates as low as sort of 1.5%, 2%, 3%. And at the moment now, the standard variable rate for a lot of lenders is close to 7%. So there is going to be a big jump in their mortgage payments once their deal ends, if they just go on to the follow-on rate. So I do say to a lot of clients who already have mortgages, like, please check your mortgage deal. If it's ending this year, you need to be reviewing it at least 6 months in advance and have some sort of plan in place. Because if you're going to remortgage your way to another lender, you need to keep a gap of about at least 2 to 3 months for that process to happen. Or if you're going to stay with the same lender, you need to see what they're offering as well. And if you find yourself you're going to be in financial difficulty, you need to be speaking to a lender as soon as possible as well. So the sooner you look at your mortgage and review it this year, the more time you give yourself to have something in place for when your deal ends. So hopefully you don't have to go on to that higher 7% rate.
Yeah, absolutely. So I expect you also contact clients, do you, to say, look, your mortgage.
Yeah.
Because I had a mortgage broker before, and used to contact. Sometimes you would, sometimes you wouldn't, and I'd get to hang on a second, and
Yeah.
I'm glad that you do, because it's good that you give people fair warning, because it can take a while to get things arranged. So people are jumping from possible fixed rate of 1.5–2% up to what, like 4 or 5?
No, like it's almost 7% now, about 7% at the moment.
But if they go into a fixed rate, they'll get less than 7%.
With the standard variable rate, so the follow-on rate, if they don't do anything with the mortgage, will be closer to 7%. If we're fixing it, yes, we're looking around. I think the average 2-year deal at the moment is about just over 4.7%.
Right.
And about 4 to 4.5% you're looking at. So your payments will go up most likely in terms of if the interest rate goes up, but it won't be as big as a jump as if you did nothing.
Yeah, so the interest payment could double, so that their interest payment, not the capital element of it, but a lot of people are on interest only mortgages for buy to let, so they could find their payments double.
Yeah,
which is as they said, a hammer blow of up to 5,000 a year average payment. So now's the time really to see a broker, not just renew with your own lender, because I've always found that your own lender doesn't seem to give you the best deal, do they?
there are a lot of lenders that they have a higher rate than which is why we always say speak to a broker. So staying with your current lender is an option potentially, but if they're not offering the most competitive rate, you want that as more of a last resort. It's always advisable to speak with a broker, see what else is offered out there as well, because depending on the size of your mortgage and the monthly payments and the terms, there could be a huge difference in your monthly payments compared to staying with your lender and not. So it's definitely better that you review the market. Your mortgage advisor, we would review what your existing lender is offering you as well anyway.
Yeah,
and
sure.
then decide, okay, like, is it better to move away from the lender onto a more competitive deal? Or depending on your circumstances and your plans, is it better to stay and do what's called a product transfer? But yeah, right, they don't always offer the best deals for retention.
Yeah, I found that if they're new borrowers, they've got all these deals and this and that. When I'm going back to them saying, what can you get? Well, this is it, take it or leave it. And it's not always the best rate. But if people want, I mean, this is the other problem, because of the rates going up, is that going to affect the affordability and the ability to even qualify for these fixed rate deals? Are you finding that? Is that becoming a problem?
Yeah, so there's a couple of factors. There is the rise in interest rates, and then there's also the rise in cost of living. So I'm finding that with residential clients, the higher interest rates are causing a decrease in affordability. So they might not be able to borrow as much as they could have last year, potentially. Also with the cost of living increase as well, it's getting harder for people to continue saving for deposits. And if you're going to be moving into a bigger property, you're going to have bigger bills to pay. And so again, when lenders factor those potential costs in as well, that is reducing the affordability at the moment for residential buyers. For buy-to-let as well, particularly in the buy-to-let market, the stress rates have increased from sort of 5.5% up to... Can
you explain what stress rates are? What are stress rates?
So a stress rate is basically when you buy a buy-to-let mortgage and you get a mortgage, you're applying for a mortgage deal, they stress it at a certain percentage. So previously, the interest rate that they offer might be 3%, but they want to make sure that you can still afford the rent that you get from the property, can still cover the mortgage payment if the interest rate was, say, 5%,
right,
5.5%. Yeah. So the rent needs to be able to cover that mortgage payment to a degree that the lender is satisfied. So there's no risk of them losing the money. The actual rate, if you pass the stress rate at say 5% or 5.5%, the actual rate you might have got what would have been maybe say 3%. But
the lender wants to cover themselves.
They want to cover themselves, so they stress it at a higher rate. Now what lenders are doing, because the actual rates have increased sort of close to 5% already, they're not stressing it at 5% anymore. They're stressing it at a sort of 6-7%. And a lot of affordability, a lot of deals are not stacking up because they're not able to reach that higher stress rate. So what people are finding is that they might have to end up putting more deposit down because they can't borrow the amount that they need. Typically, you need about 25% deposit as the minimum for buy-to-let properties, but you're finding maybe you have to go 35% instead. So one, you can't borrowers are seeing that they can't borrow as much as they need and may need a higher deposit. And then two, because of the higher interest rates in general, it's really squeezing the profit that they're getting from buy to let. So it's not as much of an attractive investment anymore.
Yes, I agree. And I've looked at some of these. I did a podcast on this where I said, where you in the past you could borrow, say, 75 or 80% on the buy to let. But if you look at the rates now compared to the rents, it doesn't add up. They're not going to give you that amount of money. And for people remortgaging, though, they're stuck between a rock and a hard place because they're already in the mortgage. What do they do when the lender says, well, we're not going to put you on this fixed rate because you don't pass the test or the affordability test? Have you come across that yet?
It is a difficult situation to be in, where you're either paying a higher interest rate on the standard variable rate and getting no profit, but you're unable to remortgage because the rent is not covering the new stress rates. So in this case, the options are really either you pay down the mortgage,
right,
bring the balance down. Obviously, you need to have a lump sum of money to do that. Bring the balance down so that it stacks up.
Yeah.
Or I think what we will be seeing this year is a lot of landlords letting go of properties just because it's not working for them. The numbers aren't working anymore, and
particularly if they've all borrowed up to the hilt and they've
with the low interest rates, people have really geared. They've borrowed the maximum and they've used that money to buy more property and taken advantage of the low interest rates. But now with the increase in that, they're finding that their monthly payments are just it's just eating up all of the rent, and they're having to pay out of their own pocket as well. So I'm expecting to see more properties coming onto the market from landlords this year.
So we hear that a lot of landlords are selling up, partly because of interest rates, but also because of increased legislation. And maybe some landlords are just retiring or getting a bit fed up with it all. It could be a combination of that, but there certainly are properties coming on. But then somebody's got to buy those properties. And I'm seeing that I had an agent call me just half an hour ago saying we've just reduced the price of this to that. I'm getting a lot of price reductions, particularly on London flats and properties. Some of them big price reductions. There's a property not far from me in Hertfordshire that was on for 1.5 million. It was a bit overpriced. It was probably should have been on for 1.3, but probably the agent said, well, don't put it on for that much. The vendor said no. Then he got it sold at 1.25. That fell through. It's now on for 1 million. That's a huge drop. And this is not some northern town. This is like in a prime area in Hertfordshire, near a station, in a sought after area. And, they're dropping prices from 1.5 to 1 million. It's a 4-bed detached house. So, if we see more of that, it's probably good for people who've got cash, but lots of people good for situations where you're highly geared. When you go on these property courses, they tell you to remortgage and get it up to the maximum and go out and don't pay your mortgages off and just keep buying and buying, rinse and repeat. But some people are going to get caught literally with their pants down, I think, in this year in terms of interest rates and mortgages. So you're already seeing this now.
Yes, we are seeing it. And you're right, the property courses there is like a set way of doing it. You just pull the maximum out, and they always say, this debt is good debt, so it doesn't matter, put out as much as possible and keep buying houses, which is, yes, in some ways, and given the market situation at the time, was beneficial. It's cheap debt, it's cheap, you can buy more property, you can increase cash flow. But when the market changes like it has now, then yes, we're finding a lot of people now realizing that because they've borrowed so much, their payments are going high and their profits are diminishing, along with the tax changes like Section 24 and things coming into effect. So it's suddenly you have to start thinking about, a lot of buy-to-let lenders are actually changing tactics. So rather than the straightforward bread and butter buy-to-let, people are looking at, okay, can we do HMOs? Can we do holiday lets? And really just pivoting and trying to figure out what the next best option is, or just selling the property.
Yeah, I've seen that, because they say that a buy-to-let doesn't add up anymore in terms of yield and lending, but HMO does. So it seems like everybody's piling into HMOs. But there is demand around London for HMO rooms. There's definitely demand. But I don't know how long that will last in every area. And then the mortgages, you're more limited on the mortgages, I know. But what about holiday lets? Because you shouldn't be taking a normal buy-to-let mortgage and then renting it out as a holiday let, should you?
No. So for holiday lets, there is a specific type of mortgage called holiday let mortgages. Not all lenders do them, so the market is a bit more limited than your standard buy to lets. And the way they work out affordability is they look at the income that you're going to get, sort of peak season, mid season, and low season, and sort of average it, and they work out what's how much they're prepared to lend on that basis. But yeah, it's a specific mortgage that you need for that.
What sort of percentage loan to value would you get on a holiday let? So you want to buy a property in Devon, and is it a lower loan to value than a normal buy to let in general? Or does it depend, I suppose it depends on the rent.
It depends on the rent. It depends on the rent and where the property is. But at least sort of, I'd say maybe 65%.
Yeah, so you're looking at about 35, and the rates are about the same or a bit higher, or
Slightly higher than buy to let. But then hopefully, if it stacks up, then it shouldn't make a huge difference in terms of your profit that you're receiving.
And would you count holiday lets in with service accommodation? This is the big thing at the service accommodation. Would you count that in the same vein
Yeah,
as holiday lets?
yeah. So
It could be a
Airbnb.
property on the coast. It could be a flat in London.
Yeah. So it's people you can, but the
Airbnb.
Airbnb properties, people come for the weekend or for the week. Potentially, you can also live in the property as well yourself for a certain amount of time, for if you wanted to, if you're using it as like a holiday home for yourself as well. But yeah, that's all in. Then that's becoming more and more popular now as well. Obviously, again, with the cost of living increasing, people are expecting this summer, more people will be traveling within the UK, so there will be more of a demand for holiday lets. So yeah, we're definitely finding more and more landlords looking at that as an option rather than your standard buy to let. But the mortgage does need to be in line with that.
Well, certainly the rents on holiday homes on the coast, anywhere near the coast, have shot up in the last couple of years, for obvious reasons. But I don't know whether that, now you can go abroad again, but it does seem that a lot of people are piling into this. Now, I think you've got to watch that. If you have a buy-to-let mortgage and then you decide, well, I'm going to rent it on an Airbnb basis, that would affect when you be in breach of your mortgage, and presumably your insurance might not cover you if you have a fire or something, and they say, well, you've been letting this to people coming and going. It could change the picture, couldn't it?
Yeah, you can. If you're going to change the use of the property, you need to check that the mortgage that you have is suitable for it, and as you said, like, you have the correct insurances in place, because you don't want to be in a position where something has happened and your insurance is not covering you, or as you said, you've breached your mortgage contract. You can end up in a lot of trouble. So it needs to be done the right way. If it's something that you're considering, again, speak to your mortgage advisor, see what the options are, and then sort of go from there. And if you do it the right way, then you don't have to worry about anything.
Presumably some local authorities would want you to do a change of use, so that is specifically for a holiday let, rather than just a residential. And the tax treatment, I believe, is different. So in terms of your interest, tax relief on the interest is treated differently as well. So it is an attractive proposition for people, but just do it properly. As Miriam said, talk to your mortgage advisor. You might need to switch your mortgage or get permission from the lender or do something. But that's something you should do properly, not just lightly and just switch into Airbnb from buy to let. So is there anything you wanted to add on the mortgage front? Any interesting deals at the moment? I saw something which is a Halifax 10-year fixed rate, just over 4%. But obviously a lot of these comes with caveats, because it may be you'd have to put down a 40 or 50% deposit, or there's some catch with it. But those are the headline rates. And I think that's why you need to talk to a broker, because they can dig in and really find out what is applicable to you, rather than just looking at a comparison site.
Yeah, so on comparison sites, obviously you'll find a whole number of deals and very attractive looking rates. But each lender is different. So in terms of their criteria, so even though the rate may be attractive, it might be for a certain loan to value, or the lender might be very fussy about, if you have bad credit, they might prefer some employment types to others, etc. So that's the reason why you speak to a mortgage advisor. So when you say is there any good rates out at the moment, it really does depend on sort of how much you're borrowing, what the personal circumstances are, whether it's a 2-year or a 5-year, whether it's fixed or tracker. So there's a lot of variables. Generally, we tend to recommend the most cost-effective deal. So this is over the 2-year or 5-year or 10-year deal period. What is the most cost-effective? Because you can get a lot of low rates where they have a very, very high product fee.
Yes, yeah. Sometimes 3, 4, 5,000 pounds.
Yes, yeah. So even 3%, 5%, it's can be quite substantial. Whereas actually you might be better off going for a product where it's a slightly higher interest rate, but a low or no product fee. So if we're looking just purely in terms of sort of lowest interest rates available at the moment, I had a look. So 90% residential, we're looking at sort of 4.8 for 2 years, 4.45 for about 5 years. That's where it seems to be the lowest at the moment. Buy to let, just a standard basic buy to let, there are deals for as low as 4.09% at the moment on 2 years, and about 4.65 on a 5-year deal.
Which historically is not horrendous. Historically, when I think back the years when I've been in properties before this sort of low rate era after 2008, I was used to paying 5-6%. I once had a mortgage at 16%. At my first residential flat, it went up from 12 to 16%, but I was happy to pay 12. People fixed their rates at 10%, and then rates went down. A lot of people got caught with that by these banking swap deals, and they become bankrupt because of it. But that's another story. But people were happy to pay 6, 7, 8, 9%. So 4% sounds horrible to people who've never paid that before.
Yeah, but exactly.
So, rates, I think, were artificially low for a long time.
Yeah, so it's easier to understand where we're at when we can look back and see it in context. So actually, the Bank of England base rate is now 4%, and it was around the 4% mark back just before 2008. It was between 6% since the 90s. So this period since 2008 till last year, where we've had like exceptionally low Bank of England base rate and mortgage rates, that is actually quite an anomaly.
Yes.
But generally, mortgage interest rates have been above, like you said, like 5%, 5, 6, even up to 8% as well. And we're coming back to that sort of times before 2008 again. I think that's what it's looking like. What's been a shock to the system is that it's just happened very, very fast in the space of like the last 12 months. The rate's just been going up, up, up. So we haven't had a lot of time to adjust to it. But actually, when you look back, this is the sort of average interest rates that we need to be used to. And I think there's going to be a period of time where we just need to adjust. I think over the last few years, because the interest rates have been very low, a lot of people have taken out other debts, credit cards, loans, and things like that. And now with the cost of living increasing and the mortgage rates rising, suddenly it's becoming very overwhelming. Is it how we're going to afford all of this? But we have to adjust to these new rates. People keep asking me, is this a good time to buy? Should I wait for the house prices to go down? Are the interest rates going to go down further? And again, it's difficult to say.
Yeah, how do you advise them?
It's hard to say. I mean, I can't say. The interest rates have steadily been coming down in terms of the mortgages, fixed rate mortgages, since about December. It has been coming down slightly. We're expecting it may continue. But will it go back down to down to 2%? No, I don't think so. That's probably unlikely. It might settle around close to 4%. Maybe.
Okay, I was going to ask you that. So you think this would be about it? Because obviously if you're sitting on cash, that's losing 10% a year due to inflation as well. So you're in danger of sitting on cash for too long, unless you're a big investor and you've got loads of money in the bank. But and I always say to first-time buyers, well, if you find the house you want and it's the right deal, just buy it, because it's not an investment, is it? This is your long-term place to live. And whether it goes up or down or sideways, you've got somewhere to live and you're not paying rent then.
And that's
not buy to let, I think.
Yeah, property, you have to remember it's a long-term investment. So whatever happens in the market in the short term, in the long term, there's such a shortage of properties in the UK. Still, and we have very limited property. There's people always looking to buy, people always needing housing. So over the long term, the value of property does tend to increase.
Appreciate,
Yeah. So if you can, and the thing is, the market has been the last 2 years, the market has been crazy. Like we all thought there was going to be a crash, when COVID happened, and the market went into lockdown for 3 months. We thought, oh no, that's it, we're going to have a crash, and nothing happened. It boomed. The government brought in the tax incentives, and and the house prices shot up. This time last year, you know, I was doing mortgages for a lot of clients who could afford the mortgage, they had decision in principles, but they just could not find a property, because anytime a property came onto the market, there'd be like 10 other people trying to buy the same property.
Yeah.
Now we're in a position where we've done a bit of a U-turn, and there are not many buyers in the market, but more property will most likely be coming onto the market this year. So if you are in a position to buy, if the amount you're looking for is affordable, you have the deposit ready and you can buy it, then I would say this is a good time. This is a good time to buy. Like you said, if you at least get your foot in the ladder, interest rates may be higher than what you're used to, but to get onto the property ladder, it might be worth it just to buy, because we can't predict what's going to happen in the future. So
that's correct, yeah. And I'm not just saying that because I sell properties through open house estate agents. I'm not just saying that, but you know, if you're going into a speculative deal, I'd say, well, I'd be a bit careful. But certainly if you're looking to buy for yourself and your family, then you know, when I bought my first flat and the rates went up to 16%, I thought I'd made a huge mistake, because prices were actually going down after that. But 2 or 3 years later, I sold it for like a 50% profit. Prices went up again, and I was away and I was off and running, and then rates started to settle down a bit. So, but I didn't just buy it for an investment. I bought it for somewhere to live. So it saves me from paying rent, and that's using up your money. So I think you're right, Miriam. If you've got the right deal and you can afford the mortgage and you're stable, then just go for it. So I think that's pretty good advice. I mean, unless you want to add anything, Miriam, I think we could.
I think
your day. But I think that's been really useful, and I look forward to speaking to you again. Maybe in the future we can do a monthly update on where the market is, where mortgages are.
Yeah, sure. I'll be more than happy.
We'll find this very useful, and we'll put up your details to contact. Now, one thing about lockdown was that people got used to using Zoom, so I'm assuming you deal with clients all over the place. Well, I used to run around and see clients, you know, South London, North London, Essex, Hertfordshire, everywhere.
Yeah. So thanks to Zoom and technology these days. Yeah, we can do appointments over Zoom. We can do it over the phone, email, all the time, whatever's easy for clients. We're pretty flexible. Some clients do prefer face-to-face meetings, and that's fine as well. That can be arranged. I'm happy to come and meet them somewhere convenient for both of us. And whatever works. But
what's the best way of contacting you? Through the company website?
Yeah, you can send me an email, or I'll give you my email address as well, or through the company website. There's a contact form, and then if you put in your query, we'll get in touch with you within 24 hours, have an initial chat, no obligation chat, and then go from there.
Fine. Okay, great. Well, I'll put your details up there, Miriam. Thanks very much for your time today, and look forward to speaking to you again. And if you want to contact Miriam, we'll put the details up in the description below. So thanks very much, Miriam. Thank you.
Thank you, Charles. Appreciate it.